Hi friends, I'm Daniellecheche, and today we're going to talk about reasons you should not be a day trader. Contrary to popular belief, it is not a get-rich-quick scheme. What? I know. These people that put in a few hours a day and then walk away with tons of money, they've put their time in practicing and perfecting their strategies. Even after all that work though, it could still be risky, and don't believe anybody that tells you differently. It also requires an in-depth understanding of how markets work. You need to be able to identify patterns, not just for that day, but in the long term. Buzz, big boy, my handsome guy. Day trading is a business, so just like anything else, you need to know your business inside and out. You also need a little bit of excess cash that you're not afraid to lose. You can't trade with money that you're afraid to lose. Otherwise, you'll put your emotions into it, and that's not gonna work out for you. Why am I so sassy? It doesn't have to be a lot, you just can't be afraid to lose it. You also need luck and good timing. I know this isn't really something you can control, but if you subscribe to any superstitions, probably time to whip them out. Do you think you can set emotion aside and only make moves based on precise plans? You can't let greed or FOMO or any other emotion dictate your trade. Plan the trade and trade the plan. Obvious alert, you need to win more than you lose. Finally, individual traders are already starting behind the 8 ball. Is that the saying? Already starting behind the 8 ball? That doesn't seem right. Starting behind, the more I say it, the worse it sounds. Institutional traders have a lot of things at their disposal that we just don't have. But with discipline, time, practice, knowledge, and a little bit of luck, you may have a chance at a successful day trading career. Did any of that scare you off? Me neither. So let's get started on a path to a successful day trading career together. I hate myself. I'm gonna make a lot of mistakes so you don't have to. Will I lose everything? Probably, but hopefully you can learn what not to do. All right, let's talk strategy. We need to talk about some different intraday trading strategies that you can implement, but I'll be quick about it. Kitty, what are you doing? Stop. Use any of these that appeal to you and play around with them. If you see something you're interested in or would like more info, leave a comment below. While you're at it, don't forget to like and subscribe. My channel's life depends on it. Trading based on news is popular and exactly what it sounds like. The market can react to economic statistics, corporate earnings, and interest rates, just to name a few. Next is scalping. That's basically what you think about when you hear day trading, but we'll talk more about this in a second. Next, there's range training. Pew pew! Not that kind of range. Did I say range training? Range trading. This uses support and resistance lines to determine buy and sell decisions. Finally, high frequency trading, which uses super sophisticated algorithms to exploit small or short-term market inefficiencies. That was a mouthful. Okay, so traders tend to use fundamental analysis or technical analysis to determine what they're going to trade. Technical analysis is basically looking at past price movements to determine what the security is going to do in the future. Fundamental analysis looks more into the company itself at its economic and financial factors. Individual traders tend to use technical analysis as well as swing trades. Do I have a stuffy nose? Technical analysis. But you can use whatever you'd like because you're your own person. All right, easy peasy. Let's talk about some ways to overcome the challenges that I mentioned. As I mentioned, knowledge is key. Keep a list of the stocks that you're interested in and stay up to date on the news that affects them. Again, set aside money that you're okay with losing and determine how much you're willing to risk on each trade. You need to have that plan in place because if an opportunity arises, you need to be able to move quickly. And I'm gonna say it again for you, don't risk anything that you can't afford to lose. Set aside some time. In addition to the time it's gonna take you to learn, you also have to wait for opportunities to come your way. If you ever wanna come hang out with me on my Twitch stream, you'll see how much time I have between trades. I know you've seen the traders with multiple screens and tons of stocks that they're watching, but we're not gonna do that. We're new, so we don't really know what to look for. So we're gonna stick with 1 to 2 stocks per session. You can change them each day, but we don't wanna be overwhelmed as we're looking for opportunities. We're also not rich, probably. So we're gonna be starting with fractional shares. Which leads me to 5. Stay away from penny stocks. As I mentioned in my first video, they're not held to the same standard as companies traded on the New York Stock Exchange and NASDAQ, among numerous other reasons. They're okay when you're a little more experienced and you know what to look for, but you'll need to do research and see a real opportunity. Until then, it's best to stay away from them. Let's talk about timing your trades. The market's super volatile when it first opens because a lot of orders execute immediately. Volatility is great, we want volatility, but it's a little overwhelming when you're new, which you probably are if you're here with me, right? It's probably best to wait until things slow down a little bit, 15 to 20 minutes after the market opens. It may seem tempting to jump right in, but you have to walk before you run. Cut your losses. I talked about limit orders in my first video. They help you get in and out at the price you want without losing too much money. Hey, I'm some boy. More experienced traders may also utilize options, and so will we. soon. Be realistic about your profits. We're all gonna lose sometimes. If you win all the time, email me. We need to be business partners. Many traders only win 50 to 60% of the time. They just make more on their wins than their losses. Keep track of your trades. You need to be conscious of how you're doing, what's working and what's not working. Make sure you only risk a predetermined percentage on each trade and your entry and exit points are clearly defined. More on those later. I said it before, keep your emotions out of it. Make your decisions based on logic and fact and not any emotion that you're feeling. Don't let your emotions get the best of you. You know better than they do. Stick to your plan. Sorry, kitties. Day traders move fast, but with a solid plan in place, they don't have to think fast. You have to develop a strategy in advance and have the discipline to stick to that plan. Stick to your formula instead of chasing profits. Are you over there wondering what to look for when you're determining what you want to trade? Well, I'm going to tell you. You need to look for liquidity. This allows you to enter or exit a stock at a good price. For instance, a tight spread and low slippage. Okay, next you need to look for volatility. More volatility equals greater profit or loss. Meme stocks are great for this. You also need to look for trading volume. It's a measure of how many times a stock is bought or sold in a particular period of time. A high degree of volume indicates a lot of interest. A volume increase is often a harbinger of a price jump, either up or down. Last but certainly not least, we're going to talk about identifying entry and exit points. We're going to look at candlestick charts, which provide a raw analysis of price action. I personally like the hike and ashy sticks, but there are multiple different types to choose from. Some trading platforms like TD Thinkorswim also provide level 2 quotes. When you're deciding when to enter, you need to make sure you write down the conditions under which you're willing to enter with a great deal of specifics. Just saying that you're going to buy in an uptrend isn't specific enough. It needs to be something that you can test. Like, I'm going to buy when the price breaks below the trend line of a head and shoulders pattern after the right shoulder, where the pattern was preceded by an uptrend on the minute chart in the first 3 hours of the day. You can easily test that, even if you can't easily say it. Just look through the charts for that pattern, and if the conditions are met and you would have made money, that's something that you could use in the future. If not, just move on to another hypothesis. You're basically a scientist now. Get used to it. When you're deciding to sell, there are a few solid ways to make sure you exit in a winning position. Profit targets are when you take your profits at a predetermined price. Scalping, which I mentioned earlier, is the most common strategy. Traders use this in an attempt to make numerous small profits on small price changes throughout the day. It happens in a matter of seconds, and you're slicing off small bits of that good stuff each time, hopefully. The next strategy is fading, which is when you short a stock after a huge price jump. You're working under the assumption that early investors are ready to take their profits and new investors are panicking, so the stock will be falling. The price target here is whenever buyers start buying again. This is risky, but it can definitely work out in your favor. Then we have daily pivots. This is something I use in conjunction with scalping. It's when you try to buy the low of the day and then sell the high of the day. The price target here is the next sign of reversal. Next is momentum. You buy when breaking news comes out about a company and sell when volume starts to decrease. Keep in mind that your stop loss should be closer to your entry price than your profit target. Again, you want to clearly define your exit strategy and put it to the test. And with that, I'm going to make my exit. Don't forget to drink your water and take your vitamins. Love you. Bye.